In the span of 48 hours, a quiet number inside the silver market jumped above 80 cents an ounce, and that single shift exposed stress in global trade that most people never notice. Not months, not weeks. In 2 trading days, the hidden toll for turning paper silver into deliverable metal surged. They said modern bullion markets could not seize up anymore. They said settlement was automated, diversified, and too institutional to break. And yet, the moment that conversion cost snapped higher, it signaled something institutions watch obsessively. The system was charging more for certainty than it was charging for exposure. Here's what makes that frightening in a calm, data-driven way. The public watches the price chart. Institutions watch the plumbing. They watch collateral rules, delivery pathways, inventory categories, and the spreads that reveal when the machinery is straining. By the time a mainstream narrative forms, positioning has already moved, hedges have already rolled, and the easiest opportunities have already vanished. That is why this story matters. Because the event is not simply that silver got volatile. The event is that settlement itself is being used as a backdoor lever, one that can redirect flows and reprice trade faster than most people think is possible. What I'm about to walk through is not opinion, it's pattern. It's the same sequence that shows up whenever a commodity market drifts too far from physical reality. Volatility spikes, collateral tightens, forced selling appears, and the premium for real-world delivery starts talking louder than the headline price. This is the part no one is discussing because it's harder to explain than a candlestick, but it is where the market reveals what it actually believes. Welcome to Trade Signal, where we decode what matters before it becomes the consensus story. The goal here isn't noise, it's signal. The kind that shows up in margin tables, clearing behavior, warehouse reports, and the spreads that professional desks live and die by. If you want more of that, stay close. And drop a comment with where you're watching from, because this market is global in a way most people underestimate. Now let's reconstruct what happened with forensic clarity, because the sequence is the story. Late December 2025, silver experienced a sharp, disorderly drop. It didn't feel like a normal repricing. It felt like an air pocket. In the middle of that move, margin requirements on a key silver futures contract were raised by roughly $3,000, taking the total requirement to around $25,000 per contract. That sounds like a technical adjustment until you understand what it does to a leveraged market. When margins rise into weakness, time compresses. Traders don't get days to adjust, they get hours. If they cannot post additional collateral, positions get cut. That forced selling pushes price lower, which triggers more margin calls, which forces more selling. It is a mechanical chain, not a debate. And it is why the decline can accelerate so quickly that it looks irrational to anyone focused only on fundamentals. Then the market tried to steady itself, and another signal appeared that mattered even more. The cost of moving from paper exposure to physical delivery, reflected in the exchange for physical premium, spiked. This premium exists because silver is not a single pool of metal. It is multiple pools, in multiple locations, under multiple standards with multiple clearing systems. When that premium is small, the system is saying conversion is easy and logistics are smooth. When it surges, the system is saying conversion is constrained and the cost of certainty has risen. So the central mystery becomes unavoidable. How can the system look plentiful on paper while the price of certainty explodes? How can reported vault totals appear large while the market starts charging a sudden toll to move metal through the delivery pipeline? Those two realities can coexist only if a portion of that supply is effectively unavailable for the specific kind of settlement the market suddenly demands. Supply can exist and still be inaccessible. It can be owned by hands that will not sell. It can be pledged as collateral. It can be in the wrong form, in the wrong place, or tied up in obligations that don't show up in the simple headline number. That distinction sounds subtle until you realize it is the entire game in stress periods. Markets are not priced by what exists in aggregate. They are priced by what is deliverable at the margin, under the rules, within the timeline, to the counterparties that need it. And when that deliverability becomes uncertain, the market doesn't wait politely. It starts repricing through spreads and settlement costs first, then through the headline price later. To see why this matters, you have to recognize the hidden pattern that repeats across decades. Settlement pressure does not announce itself, it whispers. It shows up as sudden margin hikes, as policy tweaks, as unusual premiums between venues, and as a growing gap between the story told by paper liquidity and the story told by physical constraints. The public usually arrives at the story at the end because the early signals are technical, boring, and easy to ignore. But those early signals are where the market's real fear and its real strategy live. In 1980, silver became the center of a historic squeeze dynamic. The result was not merely a price spike. The result was a change in rules. Position limits tightened, liquidation-only conditions appeared. The settlement environment shifted, and the market recalibrated around new constraints. The message was simple. When a commodity begins to threaten the credibility of deliverable supply, the rulebook becomes part of the price. In 2011, silver surged again, and once more the mechanical levers did the heavy lifting on the way down. A rapid sequence of margin hikes hit as volatility expanded. Price did not drift lower afterward. It snapped lower, and the speed shocked anyone who believed the market was only about supply and demand in textbook form. The lesson repeated: collateral rules can transform a crowded trade into forced liquidation, and forced liquidation creates prices that feel disconnected from the longer-term story. Now, in late 2025 into early 2026, the same playbook reappears, but the context is bigger. Silver is not just a speculative metal. It is industrial, monetary, and strategically important to modern manufacturing. It sits at the intersection of electronics, solar supply chains, and investor demand for hard assets. That means stress in silver settlement does not stay in the silver market. It transmits into trade flows, into financing costs, and into which regions can secure metal at predictable terms. This is where the players enter the frame, and we have to name them clearly without dramatizing them. On one side, you have the futures exchange infrastructure that defines what settlement means for a contract. On another, you have the London bullion system, which is a major hub for custody and clearing of physical metal. Between them, you have banks and dealers that intermediate the flow between paper claims and physical movement. You have industrial users who care less about narratives and more about delivery dates. You have large funds that trade volatility and liquidity, not bars. And you have trading houses that live in the space where logistics and finance collide. When an exchange raises margins sharply, it is signaling that volatility has made the system fragile. It is framed as risk management, and it is. But it has a predictable consequence. It forces deleveraging. It concentrates survival among those with deeper liquidity. It pushes risk out of weaker hands and into stronger balance sheets. In other words, it changes who controls exposure. That is institutional movement, even if no single institution is named in a headline. The action is in the rule. It tells you that the clearing ecosystem is not confident the first tightening fully restored stability, or that the underlying stress continues to simmer under the surface. This is coordination without a meeting. It is a shared response function. One lever moves, the market convulses. Another lever moves, and participants learn a new boundary for risk. At the same time, the physical side tells its own story, and it often contradicts the paper story. Vault data can show large totals, but custody is not availability. Some metal is allocated to owners with no intention to sell. Some is held against long-term obligations. Some is used as collateral in financing structures. Some may be subject to encumbrances that make it practically immobile. And some is simply not in the form required for easy delivery into a different venue without time, cost, and conversion. You have the public-facing price, which is the price of the most liquid paper instrument in the moment. And you have the private price of certainty, which is what someone must pay to ensure deliverable metal in the right form, at the right place, on the right timeline. Under normal conditions, those two prices track closely. Under stress, they split. A rising exchange for physical premium is that split made visible. And that is not a curiosity, it is a warning, because a split like that cannot persist indefinitely. Either the paper price must rise to reflect the true cost of physical certainty, or the physical chain must loosen, or the system must change how settlement pressure is handled. Markets resolve these tensions. The only question is how and who absorbs the cost along the way. This is the part where it becomes clear why settlements can change global trade overnight. If paper cannot reliably convert into physical without paying a growing toll, then paper becomes a different product. It becomes exposure without guaranteed exit. It becomes a claim that behaves smoothly until the day it doesn't. And when that day arrives, settlement choices redirect flows. Metal that would have moved from one hub to another might stay put. Buyers that expected delivery might accept cash. Industrial users might pay up for assured supply rather than risk a delay. And that shifts real-world purchasing behavior, which is how a settlement detail becomes a trade shock. Let me make the mechanism intuitive without flattening it. Imagine a city where everyone trades fuel credits on an app. Most of the time, you can redeem those credits for actual fuel at any station instantly with a tiny fee. The credits become almost as good as fuel. Then, in 2 days, the redemption fee jumps sharply, and certain stations limit how much you can redeem. The app still shows a price, and trading still continues. But the real economy changes. Trucking companies start paying extra to lock in guaranteed fuel. Smaller businesses accept credits they can't easily redeem. A few well-capitalized operators buy up guaranteed access because they understand that certainty is now the scarce good. That is what settlement dislocation does in metals. It turns a smooth financial layer into a bottleneck. And once a bottleneck appears, the entities with direct access and deep liquidity gain an advantage. They can pay the premium. They can meet the margin call. They can source metal from the right location. They can handle paperwork and timing. Others cannot. and so they are pushed into weaker forms of exposure. Now, let's lay out the evidence in a way that is hard to dismiss. First, the margin requirement shift. A roughly $3,000 increase per contract is not small when you scale it across thousands of contracts, and consider that margins rise precisely when volatility rises. It is the worst moment to demand more collateral from a leveraged system, which is why it forces liquidation. Second, the rapid jump in conversion cost. Rising past 80 cents an ounce in a compressed window is not normal for a market that is supposed to be smoothly arbitraged between major hubs. It is a sign that the linkage is stressed. There is another contradiction that makes the settlement story unavoidable. When prices fall violently, the casual assumption is that physical supply must be abundant. Yet in real commodity chains, sharp price drops often happen precisely when supply is tight, because tightness increases the value of leverage and the fragility of leverage at the same time. Producers hedge future output, consumers hedge future input costs, speculators borrow short-term funding to hold exposure, and that borrowing depends on confidence in collateral. When financing conditions tighten, it behaves like a tax on participation. The same contract size suddenly requires more cash. The same inventory suddenly requires more financing. The same hedge suddenly requires more collateral. That is why a market can fall even while real users still need the metal. The selling is not always a statement about abundance. Sometimes it is a statement about balance sheets. Now look at who benefits from the reshuffle when that bridge is stressed. A bank with diversified funding can meet a margin call and keep its hedge intact. A large industrial buyer with strong credit can secure supply through term agreements and treat short-term volatility as background noise. A trading house with logistics can source metal from the right location, convert bar standards, and deliver into the tightest point in the system. Meanwhile, a smaller participant is pushed away from delivery certainty and toward synthetic exposure that feels liquid until it is tested. This is why the market can look calm and chaotic at the same time. The futures screen shows continuous trading in tight bid-ask spreads. But behind the screen, the settlement ladder narrows. Fewer actors can climb it. The price of each rung rises. And when that happens, global trade adjusts in subtle ways that add up. Importers change shipment timing. Fabricators alter inventory buffers. Refiners prioritize certain clients. Even the definition of available stock shifts, not because metal vanished, but because metal became harder to mobilize quickly. And when incentives change, behavior changes first, then prices follow, and only after that do headlines arrive, explaining a move that already happened to everyone in full. Here's where it gets interesting. Official narratives tend to frame this as simple volatility management. Margins rise because volatility rose. Premiums rise because logistics got busy. But timing reveals a more precise story. When you see margin hikes land into weakness and conversion premiums spike, you are watching the system reduce the ability of leveraged capital to press its bets while simultaneously revealing that physical certainty is getting scarcer or costlier. The effect is a quiet reallocation of power toward those who can survive higher collateral and pay for certainty. Notice how clean that is. No conspiracy is required. The mechanism is sufficient. In every complex market, rules and frictions decide outcomes as much as supply and demand do. The difference is that in calm times, the frictions are small enough to ignore. In stress times, frictions become the market. This also explains why different regions can see different prices, even in a globally traded metal. If one settlement hub becomes expensive to source from, importers seek alternatives. If financing becomes tighter, inventory behavior changes. If the cost of certainty rises in one center, demand can migrate to another center where delivery is smoother. And because silver is used in industrial processes, any disruption in predictable sourcing can force manufacturers to adjust procurement behavior. They might extend contracts. They might diversify suppliers. They might hold more inventory than they prefer, simply because uncertainty is now priced in. So what does this data pattern suggest historically, without making promises? It suggests a range of outcomes that tend to follow settlement stress. One scenario is conservative. Volatility cools, margins stabilize, and conversion premiums compress as logistics normalize. In that case, the system absorbs the shock and the episode becomes a footnote. But even then, participants remember that conversion costs can jump quickly, and they price that risk into future behavior. That makes the next stress event easier to ignite because everyone knows the lever exists. A moderate scenario is that the split persists. Paper liquidity remains deep, but physical certainty remains costly. That creates a two-tiered market. Those who can access physical efficiently arbitrage, hedge, and accumulate optionality. Those who cannot remain in paper, exposed to a system that may not reward them with delivery when they want it most. Over time, that can alter forward curves, widen spreads, and embed a persistent premium into the cost of doing business for anyone who needs real metal. The aggressive scenario, historically, is a structural resolution. Either paper prices adjust upward to reflect the real cost of certainty, or settlement practices evolve to reduce delivery pressure, such as greater reliance on cash settlement or different incentives around delivery. When that happens, it feels overnight, because the visible price moves all at once. But the conditions that made it possible were building in quiet data for weeks. The market does not snap because it is moody. It snaps because the tension finally exceeds the system's tolerance. If you want to understand which scenario is developing, watch a few specific indicators. Watch the conversion premium itself, because it is a direct signal of settlement friction. If it remains elevated or spikes again, the pathway is still stressed. Watch margin schedules and any further tightening into volatility, because that tells you whether the clearing ecosystem views the risk as temporary or persistent. Watch warehouse classifications and reported movements, because shifts in classification can change what counts as deliverable in practice. And watch volatility itself, because a high volatility regime makes every settlement constraint more binding. Here's what most people miss about those indicators. They are behavioral constraints. A higher margin requirement changes who can participate. A higher conversion premium changes whether arbitrage can keep prices aligned. A higher volatility regime changes whether participants hold inventory or avoid it. Those constraints shape the market before any commentator can narrate it. Now we arrive at the choice ahead, and it is not about being smarter. It is about watching the right layer. Most people interpret silver as a chart and a story about inflation, industry, or sentiment. But the people who consistently avoid being surprised watch settlement. They watch who is forced to sell, who is allowed to hold, and what it costs to convert a claim into a bar. Information gap becomes wealth gap, not because anyone is evil, but because markets reward those who understand mechanisms before they become obvious. Institutions move first because they have to. They manage collateral. They manage delivery obligations. They manage risk limits. Retail reacts last because retail has shown the outcome, not the process. By the time the narrative is simple enough to spread, the leverage has already been flushed, the premiums have already signaled the bottleneck, and the quiet winners have already positioned around the new rules. So when you hear silver settlements and backdoor system, don't imagine a shadowy plot. Imagine a set of rules and frictions that can redirect behavior at scale. A margin hike forces liquidation. A conversion premium forces a choice between paper exposure and delivery certainty. A shift in what counts as deliverable supply changes how secure a claim really is. These are quiet tools. They do not need a press conference. But they can move markets faster than any speech, because they operate at the level where participation is either allowed or denied. And that is why this matters beyond silver. Anytime you see a market where paper exposure is enormous and physical delivery is finite, settlement becomes the battlefield. It is where reality meets accounting. It is where risk management becomes price formation. It is where the world learns, sometimes abruptly, that liquidity is not the same as availability. This is trade signal, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. Because the question isn't whether settlement dynamics will keep shaping outcomes. The data already shows they do. The question is whether, next time the spreads start whispering, you recognize the signal before the story reaches everyone else.